Oh man, this new jobs report has just flipped the script for Bitcoin. We just had a nasty, hot jobs figure come in, which could change the plan for the upcoming FOMC meeting. We can see Bitcoin is down 1.2% here today. It could have been a lot worse. We're going to jump into the charts to take a look, but first and foremost, we've got to take a look at this ADP jobs figure, hot off the press, comes in at 278,000 new jobs versus the consensus, which was 170,000 jobs. Now remember, the ADP is a private jobs figure which gives you a precursor for what to expect tomorrow in the non-farm payrolls. But if you couple that along with yesterday's shock jobs figure, which is the number of job openings, that came in at 10.1 million versus the 9.9 million. This shows that we have a very hot labor market and there is no imminent sign from this data that we are heading into a recession. Take those two figures, couple it with the hotter than expected PCE inflation reading from last week, and we sit here wondering whether we are expecting another 25 base point rate hike in 2 weeks' time at the next FOMC meeting. But then why is it that the market has flip-flopped? This is just mind-boggling, right? Why is it now that the market flipped again? Remember, it was initially this way where the majority of the market thought we'd pause. Then a couple of days ago, it was the other way around. When we checked it yesterday, it was the other way around as well, where 65% plus of the market was expecting 25 base points at the next meeting. Now it's flipped again, right? 64% of the market have now priced in that we're going to pause. How does that couple in with the data? And in fact, I'm going to refresh this now to see whether it's changing live as the market kind of absorbs this new ADP jobs data. Because if the market's hot, this gives the Fed more permission to increase rates. If there's no imminent danger of a recession, the Fed can go ahead and continue to fight their battle against inflation. Remember, their remit is to keep the labor market healthy, but at the same time, keep inflation down to their 2% target range. So if the labor market is not softening, they have no reason to pause. But markets so far are focused on the fact that there have been certain Fed officials such as Jefferson and Harker yesterday who started leaning on the dovish side. Yes, we covered this off yesterday. If you're not in the Telegram group, ijaz.uk/Telegram, also on my Twitter, you get the live updates, guys, in real time, and it's all completely free. So when Jefferson was speaking, I posted the updates here. He said skipping a rate increase at a coming meeting would allow Fed officials to see more data before deciding on the extent of additional tightening. He then said that monetary policy works with a lag, and a year is not long enough to feel their full effect. He said skipping a hike would allow us time to assess the data, higher rates could exacerbate banking stress, inflation remains too high, progress has been slowing recently. Fairly dovish, right? So the markets have taken these dovish comments on board overnight yesterday, but at the same time, the data has just come out, whether it was the job openings figure, whether it was the ADP, which we've just seen, to say, hang on, the jobs market is still hot. This gives Jerome Powell remit to go and do another 25 base points, go and carry on tackling inflation. Now, tomorrow, we get the most important of this week's figures, which is the non-farm payrolls. Okay, so the ADP normally acts as a precursor for tomorrow's figure. That's expected to come in here at around 180 to 190,000 new non-farm payrolls. Last time it came in at 253. So that's what we need to watch for tomorrow. Anything more than 190, this market shows that the labor market is too hot and 25 base points could be on the cards in the next 2 weeks. Now, couple that with the fact that markets are still worried about the debt ceiling, and that is why now we're seeing where we're at today. If you look at the pre-market today, we're fairly flat. Markets are feeling a little bit positive because the debt ceiling did pass the House yesterday, and will now go for vote in the Senate. So it could take another couple of days as the Senate debate the bill, but most people are expecting this debate to go through. It might just take a little bit of back and forth, okay? So hopefully we're through the worst of this debt ceiling drama, but the longer they leave it, the worse it could be, okay? The other thing to then jump and take a look at is that Bitcoin fell from its symmetrical triangle. We spoke about the symmetrical triangle breakdown, and then yesterday I tweeted that when we were hanging up here, I said look out for the next support at 26.6, and sure enough, you can see exactly that is where it hits. If you jump on over to my Twitter, you will see this is exactly what we spoke about. Here is the quote, and if I click on the original tweet, you guys will see when the price was hovering here, I had this support line. I said, watch out for this level at 26.6. And sure as hell, we came down and we hit 26.6 as support. Now we need to look for the next level. And the next level will be to focus on 26.2. That's this orange line here. And this will come into play if we're unable to get a higher high. If we cannot get above this peak here, which sits at 27.3, I am expecting that if we fail earlier than that, then we could be revisiting 26.2 in a continuation of the downward trend. Another way to look at this is to look at it through the channel, right? If you want to take a look at the channel that Bitcoin's forming, you can see here, if I zoom out to the 4-hourly chart, we're clearly in this downward channel. And in our impulse move to the upside, we didn't even go to the top of the channel. So this is showing good strength for the bears right now, unfortunately. So we've got a lot of work to do as bulls to keep this upward trend. Remember, if we lose this upward trend, not only do we lose that section there, but we lose this bigger cup and handle pattern, which gives us a price target of 45. Now, the other way to look at it is if we zoom out to the weekly chart and bring out our EMA ribbon, you will notice, very importantly, we are still bouncing off our EMA ribbon. We're still holding this EMA ribbon. And this is what's giving me comfort in this market. Remember, I continually said, if we lose below 25,000, we lose our EMA ribbon. Now this EMA ribbon is getting higher and higher, right? So now if you look at the bottom of the EMA ribbon, this wicks at 25,300. So now if we get a close below 25,300, then I'm worried, because then we lose our weekly EMA ribbon. And that number is going to get higher and higher, right? In a couple of weeks' time, that'll be 25,500, 25,600, because it's edging up the EMA ribbon over time. So it's important that we bounce from here and we get above 30 and 31. I can't stress that enough. I'm going to mention that every single time. We got to get above 30. We've got to get above 31. Otherwise, we're showing weakness here. It'll just be a matter of time before we lose our EMA ribbon if we cannot show strength to the upside to break the local resistance at 30 and 31. That's very, very important here. Now, until we do so, we have to understand and respect the fact that the bearish patterns continue to play out. Right? If you look at this head and shoulders pattern which we had drawn, so many people shouted that, oh look, we've invalidated our head and shoulders pattern. I came out and said, guys, the way I've got my head and shoulders drawn, this is not an invalidation of the head and shoulders pattern. We simply retested it. And you can see exactly where we wicked was where the neckline of my head and shoulders pattern is. Now, if you want to learn all this TA stuff, if you want to learn head and shoulders pattern, if you want to learn EME ribbon, ijaz.uk/TA, you'll be able to grab my TA course. That's over 10 years worth of TA experience from traditional finance, investment banking as well. All my future lectures will be in there as well. And I've got a host of advanced metrics I'm going to be added into there as well. You get a whole bunch of other things, such as my trading checklist and my position sizing calculator and various other things bundled in there as well. So definitely take advantage of that. And the price will be going up. So do so soon. So this price target continues to play out. And the worrying thing for this head and shoulders pattern is if we start falling to this level here, if you look at where we wicked on this initial move to the downside here on the head and shoulders pattern, we wicked at 25.9. If this move gets us lower than 25.9, then that price target of this head and shoulders pattern comes straight back into play, 24,100. And that's a nasty price target, right? That would mean we've lost our weekly EMA ribbon and we could be heading into a longer downward period / sideways period for Bitcoin. We certainly would have lost our initial upwards momentum that we've started the year off with here in 2023. Another way to look at it, you guys know there's very important support at 25. And this is the simple way I like to look at the chart, right? If I want to just simplify it and get away from the noise, how do I think about this chart? I think about this. We were here, we're in this horrible period for ages, and we got rejected once, we got rejected twice by roughly 25,000. It's actually 25,200, but call it 25,000, right? Then we finally broke through it. Now it's only right and healthy that we retest this level, which is what we're flirting with right now. But it's only a retest if we can go and keep pushing on, right? Otherwise, it's not a retest. If we fall back into here, it was not a successful retest. It was just a fake out. We broke out. We just came back in, and we're back into the sideways trend again. So it's critical. It's critical that when we do now start to move, we get above this peak, 31. I can't stress that enough. We've got to get past that peak here with some momentum to the upside. Now, resolving this debt ceiling could help. If we get a pause at the next FOMC meeting in 2 weeks, that could help. But also, those things can move the other way, right? We could have more tension from the debt ceiling. We could have another 25 base point rate hike, and that could stop us from some of the momentum to the upside. Now, the other thing I need to remind you guys of is that if you actually look at it from a weekly chart perspective, it's very important to understand that the volume really does start to thin out. We spoke about this yesterday, but this is an important cluster of resistance, okay? This is supposed to be a bit of resistance. We're supposed to face a little bit of challenge because when we fell so sharply on Bitcoin, when we started falling from the levels of 40,000, let me illustrate this for you guys. When we collapsed, it was this doji candle, okay? Look at this doji candle here. If you don't know what doji candle is, we go through it in the TA course, so you'll be familiar with it. That would have signaled a horrible reversal on that weekly candlestick. And then big fall ensued, right? We dropped then from highs of 48,000 there, all the way down without any respite really, all the way down to 17,600. Horrible fall. The only slight respite we had was in this period, which is exactly where we're battling for now. 30,000, okay? And again, why is that such an important level? You need to go back to the summer of 2021. The summer of 2021 in this period here, where we held that 30,000 level as well. Okay, so this level shows a lot of historical significance. We were always supposed to struggle at this level. You can't just turn resistance into support very quickly. So it's okay that we've spent a couple of months moving sideways here. But once we clear this level, in my opinion, there's a very big gap to fill. We should be able to fill that gap up towards 45, 49 quite quickly up here, right? Look at this, 46, 47 is this area here. This gap should fill quite quickly once that bullish momentum comes into play. We do have some positive news on the dollar index front, and that is that the dollar index of the last 4 or 5 candles here has started curling over. Remember, a lot of the recent pain on Bitcoin has been because dollar index has been rampant. It went from below its EMA ribbon here, regained its EMA ribbon, and had a nice, powerful extending move. Look at the EMA ribbon now. It's flipped. It's bullish on the dollar index. Remember, we want this down. Dollar index inversely correlated to Bitcoin. Keep it down. Keep risk on. This is a risk-off move, right, because of the debt ceiling troubles. So if we can get this debt ceiling resolved, like we're seeing here, I expect this to curl over and come back into the EMA ribbon. As it comes back into the EMA ribbon, it's imperative that we flip that EMA ribbon back to the downside. If we can do that, the chances of Bitcoin then bouncing from its daily EMA ribbon and getting back above it will increase. And that's what we need to happen. We need the dollar index to go down. We need Bitcoin to move up. We need risk to rotate back on. The NASDAQ and risk on places should do better, and Bitcoin as well. But there's a lot of work to do. And right now, the data is suggesting that a recession is far, far away at the moment. The markets are healthy. Companies are delivering decent earnings and giving decent forecasts. We've seen the AI boom recently with Nvidia and associated stocks. Seen many companies start to rally off their bottoms. We've seen positive jobs figure showing really hot labor market. ADP jobs figure showing a really hot market. Tomorrow we get the non-farm payrolls. And all of that lines up, say, hang on, Jerome Powell might just do another 25 base points because while he's got the opportunity, while the market is not having a hard landing right now, he can finish off the work of inflation to get it back towards 3% and then the 2% target range, right? Instead of leaving it, pausing, and maybe never getting this chance thereafter. The other thing to update you guys on is we've got an interesting update in the stablecoin space as well. CZ tweeted this, that the First Digital unveils USD stablecoin as Hong Kong crypto rules kick in. So they're launching this coin to be issued on Ethereum and the BNB smart chain. Okay, and this is good. Remember, I constantly pointed out 2 things as risks in this crypto space. One, the monopoly in the exchange space. Binance is the biggest exchange by far, and we need more competition. And secondly, stablecoins, right? With the closing of BUSD, you can see that Tether is by far the biggest stablecoin, and we need more competition. So this is a welcome sign. Let's see how they get on with their new stablecoin, which is going to be called FDUSD. I think that's a bit of a tongue twister, but nonetheless, that's good news. Another stablecoin, more on ramps. As they try to choke, as the establishment tries to choke crypto, let more opportunities be created where people find solutions to get us back onto crypto. And if there's a will, there will always be a way. Hope you guys enjoyed this update on the jobs figures. If you appreciate this, smash the likes. Don't forget to subscribe. I will be posting another video later today on a practical day trading strategy. So make sure you look out for that one as well. If you want more of those types of videos, you've got to let me know in the comments. And I'll see you in the next one.